Hi, options trading allows us to make money even when stock prices remain stable. We discuss the distinctions between two neutral strategies, the Iron Condor and the Iron Butterfly, and share our preference between the two. If you enjoy my videos about investing in US stocks, please like and share my videos and subscribe to my channel. Thank you. We'll talk about 5 key points today. 1. What is an Iron Condor? 2. What is an Iron Butterfly? 3. Differences between an Iron Condor and an Iron Butterfly. 4. How to find profitable Iron Condors. 5. Best Iron Condor options to trade. The Iron Condor is an options trading technique aimed at making money when the underlying stock have minimal price changes. It's seen as a safer strategy with controlled risk and profit probabilities. To successfully trade an Iron Condor, we should take the following steps. Purchase a lower strike put option to safeguard against a significant drop in the stock price, and sell a higher strike put option to earn some premium income for the trade. Buy a higher strike call option for protection in case the stock price rises sharply, and sell a lower strike call option to generate additional premium income. An Iron Butterfly is a type of neutral option strategy that focuses on making gains when the price of the underlying asset fluctuates within a narrow band. When trading an Iron Butterfly, we will execute the following steps. Sell an at-the-money call option to receive a premium. If the stock price rises significantly, the buyer has the right to purchase the stock from us at a lower price. Sell an at-the-money put option to receive a premium also. If the stock price declines significantly, the buyer has the right to sell the stock to us at a higher price. Buy an out-of-money call option to partially offset the risk of selling the ATM call option, and buy an out-of-the-money put option to partially offset the risk of selling the ATM put. The Iron Condor and Iron Butterfly are popular neutral strategies in options trading. Although they have similar structures, there are important distinctions between the two. In trading an Iron Condor, the strategy involves buying and selling out-of-the-money options, which means the strike prices are further from the current market price. This setup boosts the chance of earning a profit. An Iron Butterfly starts with selling 2 at-the-money contracts, which can lead to a higher maximum profit potential. But the stock price moves, one of the sold contracts will always end up in the money, meaning it will be exercised unless it's repurchased before expiration. In contrast, with an Iron Condor, as long as the stock price stays between the strike prices of the contract, traders can let the options decay in value until they expire worthless. This is why Iron Condor traders typically don't need to adjust their positions very often. Both strategies can be profitable when the stock price stays fairly stable, but the Iron Condor provides a broader profit range. This allows it to remain profitable even with a bit more price movement. As a result, many traders tend to favor Iron Condors over Iron Butterflies. We use the option scanner to find high probability neutral opportunities. To allow theta to decay sufficiently, we will filter for stocks with an IV percentile of at least 67% for options expiring in the next month. This indicates that the stock's implied volatility has been higher than most of the past year, suggesting a greater likelihood of IV contraction, which will help reduce vega. To minimize the impact of earnings reports on options prices, we will only consider stocks that are more than 30 days away from their earnings release date. Among the stocks that meet these criteria, we will further rank them based on the return on capital of Iron Condors to identify potential neutral trading opportunities with the highest expected returns. By using the Iron Condor ROC ranking, we can identify the current low-risk Iron Condors with the highest return on investment at a 20 delta. Right now, the Iron Condor strategy with the highest return on investment at a lower risk is Tesla. You can create a 20 delta Iron Condor by selling a $190 put and buying at a $185 put, then sell a $280 call and buy a $285 call. This setup will require $335 in purchasing power. If Tesla's stock price remains within the strike prices of the sold options until expiration, you could potentially see a profit of up to 49%. Compared to Iron Butterfly, we prefer the wider profit range of Iron Condor, which also requires fewer adjustments. You might also want to use the option scanner to identify low-risk, high-reward neutral trades.